welcome. You're watching yet another edition of Market Masterclass on Money 9. I'm Sakshi Patra and I'm back with yet another edition with a very special guest joining in. Mr. Sudip Bandhopadhyay, Group Chairman of Inditrade Capital, joins in. Thank you very much, sir, and welcome back to Money 9 on Market Masterclass. Hope you have been absolutely fine in this time of crisis. But let me begin by understanding from you, how are you looking at the markets currently, especially with respect to a little bit of talking about the last year and this year's trend as well. Now, last year, sir, we had seen that during the first wave, when the national lockdown was announced, soon we started to see that a whole lot of participation happened from the retail investors here. Over a crore demat accounts were opened in 2020. Are you seeing similar trend also happen in the second wave of lockdown amid this another increasing phase of lockdowns that we are seeing? So what is your sense of the markets currently at this point in time?
Well, Sakshi, thank you. Thank you for having me, and we are all safe and sound. Hope you and all your colleagues are also safe and sound, and our viewers remain safe and sound. As far as the markets are concerned, Sakshi, there is a significant difference between what we witnessed in the last year, same time, and what we are witnessing now. The major difference is last year, the entire world was grappling with this unknown virus and nobody had a solution. So it was a worldwide phenomenon and people were confused, at least initially, and they didn't know what to do and how to go about things. And nobody knew for sure how long this will continue. The difference between that scenario and now is that now we have a vaccine. I mean, why? One, we have multiple vaccines available, and the many countries have fully vaccinated or are moving towards getting their citizens fully vaccinated. We have few setbacks in that space because we don't have somehow the pace of vaccination hasn't picked up, and it's a little bit of worrisome. The second wave has hit us, and the lockdowns are going to affect the GDP once again, and that's a little unfortunate. So that's the fundamental difference. Now, as far as the markets are concerned, there has been a significant injection of liquidity by all the countries, almost all the countries in the world. You take the US, UK, European Union, Japan, and all other developed markets, and even India. I think the central banks have injected significant amount of liquidity, and that has helped the market buoyancy in a very, very big way. The investors were generally in a risk-on mood, and they kept on buying shares after the initial period of setback last year. Now, this year, the fundamental difference is while the risk-on mood continues for the global investors, US markets are touching all-time highs regularly, but the scenario in India is different, and that's why investors are being cautious. And that's the reason we are seeing that every rise is being followed by a profit booking and a dip. And that is a little worrisome as far as Indian markets are concerned. Now, the retail investors came in droves, they participated in a big way, and as we see, the demat account numbers really ballooned. This time, I think retail investors are a bit cautious. They are a little confused because the COVID has hit home now. I think everybody has a story to tell now, unlike last time. So I would be a little cautious on that, though we are optimistic on the medium to long term.
Absolutely, sir, and I wanted to come to that only because in the last few trading session, we have seen some bit of short covering taking place, and the markets are showing some resilience at this point in time, despite all the negative news of record high cases being clocked in on an everyday basis. But are the fundamentals really in place to support a sustained rally? Is the question currently.
Well, I would take it in two parts, Sakshi. I think, first of all, as I mentioned, there's a difference between last time and this time. Last time, the liquidity fueled the rally. This time also, there is enough and more liquidity waiting in the wings. It is just that we need to get over this second wave. And the global experts and Indian experts are all saying normally the second wave and third wave are for a very short duration. So pretty much everybody knows that somewhere it will end soon, and they need to be positioned for taking benefit of the rally post the wave gets over. So this is the reason why people are still bullish, and there is still the resilience in the stocks. Market is not crashing; it is volatile, moving sideways, but it's not crashing. There has been correction. Of course, from the high levels we have seen in February and March, there has been good amount of correction, but there is hope. And there is obviously buying at every lower level also. But it's range bound, it's not going up as well. What we believe is that the investors who want to build their long-term portfolio, there are definitely significant opportunities in good stocks at current levels, which they need to focus on.
Beat the volatility blues at this point in time? What is the best way to do that?
Well, I think there are sectors and stocks which the investors need to focus on. We believe that there is a commodity super cycle going on. And look, this is not a matter of 1 year, 2 years. I think this is going to continue for some time. You name the commodities, whether it's agri or non-agri. We saw a massive rally in ferrous and non-ferrous. All the steel companies went up. All the other metal companies went up significantly. And now we are seeing a massive rally in the agri commodities as well. And I think this is here to stay. So I would urge the investor to look at the sugar stocks at this stage, because there is I think a multi-year re-rating will start in sugar because of the government's policy on ethanol blending. They are trying to push it to 20%, which is a fantastic move. And coupled with shortage in production in Brazil and Thailand, I think, and the opportunity of export, the Indian sugar industry is going to have a great time. So investors should focus on top tier sugar companies having a manufacturing base in northern, eastern and western part of India, like a Balrampur Chinni, Triveni Engineering, that they should look at. The second sector, second sector, Sakshi, I'd like to mention is again a part of the commodity cycle, but indirectly is a cement. I think, there are multiple factors for cement to do wonders going forward. There may be a dip in Q1 because of the lockdowns, on account of the second wave of the pandemic. But cement is a great sector which will do wonders for the next maybe couple of years at least. With the infrastructure spend of the government as well as the private sector spend and the home for all related cement requirements, I think cement companies are going to do well, particularly companies having production facility in north, east and central India. This is a cement deficit a pocket of India where the supply is lower than demand. So they have a pricing power, they have the demand with them. And in this space, I will talk about a company, Birla Corp. I think it's fantastically positioned. They have the manufacturing facilities in the right geography. They have done the right things by some strategic acquisitions which give them access to captive coal, which is the fuel. They have put their own railway sidings. They have their solar power to meet their energy requirement. So overall, again, I think this is a fantastic company. Other cement companies like one of the large cap SEC can also be looked at.
Okay, so cement and sugar stocks, those are something that all the investors should definitely focus on currently, and with specific stocks that you've also talked about, they can be definitely kept on the radar. What is your view on the metal space? We have seen continuous outperformance from this space, but is the rally here to stay? There is a complete divided opinion out there. There is one set of brokerage houses really bullish on the stocks in the steel metal space. The other side saying that the steel is now done and dusted. Where are you at currently on this space?
Well, I think I'll take a slightly different view and try and divide the entire sector. There are ferrous metals, there are non-ferrous. I think we've seen a massive rally in steel and all. So I will probably be a little cautious. It doesn't mean that it will not rally, but I'll be on the side of caution. If I have to play the steel, probably I'll go to iron ore company. Because iron ore, I think there is a global demand and the global export opportunities as well. And we have a fantastic company, NMDC. I think they have also, beyond the global iron ore prices moving up, there has been a strong demand from the steel manufacturers in India because of increased steel demand. The prices of iron ore, I don't think are going to come down below $100 per metric ton. And that's a very good sign. Second thing is they have done the right thing by diversifying their customer base. They have got out of their unrelated diversifications like the steel mill and all that. So overall, NMDC at current level, I would prefer to play the rally through. The second stuff, I would talk about the non-steel and non-ferrous areas. I would try and take a bet on maybe a Hindalco and a Nalco at this stage and try and play that, not the steel part of it.
Have to say on the pharma space specifically, sir, we have seen a good rally over here. Of course, there's this COVID-19 theme, and all the stocks are, getting this momentum lift right now currently. But for long-term investors, is the story here to stay? For anyone who's looking to, tap onto these pharma majors, whether it is the vaccine plays, whether it is APIs or hospitals or labs, what would you really suggest to them? What should be the prudent strategy to follow in the pharma sector?
Well, if somebody is looking at long-term, Sakshi, I have no doubts I will talk about the pharma. I'll not go to the hospitals and the labs because they are a function of this excitement around COVID and things like that. I'm not saying they're bad or they have any problems, but the excitement there is pretty much baked in the price already. So whereas the Indian pharma is, I think, going through a multi-year re-rating. Look, pharma didn't do anything for last. Leave aside last 8-10 months, they didn't do anything for 3-4 years before that. And now I think Indian pharma is again back in focus. They have got their act together. There were challenges, there were regulatory issues. US FDA has time and again pointed out regulatory issues in Indian pharma, but they have got out of that and they have kind of spruced up their act. And at this stage, I think leading Indian pharma companies definitely deserve attention from investors. I would like to mention a couple of leading players like Sun and Lupin. I think both look extremely good at current level. They are leaders. They had their own set of challenges. They have gone through fire, and now I think next 2-3 years are going to be excellent. Both stocks have rallied quite a bit, but from here on also they have the capacity and opportunity to move up significantly. So investors, at least the guys who are not active traders should definitely look at these two, Sun and Lupin, and invest in these.
Right. But what would you say to investors like to completely avoid or exit at this point in time, sir?
Well, I think, it's very difficult because market is going through such a volatile period. Exit, I am not very sure. But if you really push me to say some names, I will say maybe book your profit in steel. Maybe, be little light on some of the FMCG stocks, and maybe some of the hospital and this lab you can exit because they have rallied quite a bit, and at some stage I think they will show the fatigue.
Right. And last word from you on the kind of increasing restrictions that we are seeing. Is that going to have a negative impact on the earnings front going on forward from here? And how should investors really take that point?
Well, actually, my view is, I only can talk about people who are looking at medium to long term. I think they should not worry about this because this phase, like we have seen last year, we were very worried in March, April, then the market started rallying because we knew that COVID is going to go away. I think the same thing will happen as far as second wave is concerned. We are really, really under pressure and disturbed at this stage. That's getting reflected in the market, but this is a passing phase. So we have to be patient. And I think markets will reward patient investors. At this stage, it is always good to kind of pick up the good stocks and start investing and building your portfolio. You probably wanted to buy these stocks because of the rally you didn't buy. So now go and buy them.
Okay, now is the time to buy them if you've missed out on the rally earlier, because this phase will pass on and the markets will have brighter days ahead as well, which will definitely give a fillip to your portfolio going on forward from here too. Thank you very much, Mr. Bandhopadhyay, for sharing your views on the market perspective, the specific sectors that you're looking at and the rallies which can start and the re-rating which can start in particular sectors like sugar and cement as well. Thank you very much for taking some of the names as well, which investors will definitely keep on their radar from here on. And with that, we wrap up this edition of Market Masterclass with you, but a whole lot of action is awaited on the other hand, so stay tuned onto Money9.